Yo, and welcome back. My name is NARLOD. Earlier, before I had introduced the video, I was in the field. So let's get on to the real thing now. So recently we've been going through the basics, and now we want to get into the main stuff deep inside. 3 things that you need to know as you start. Well, we need to have a strategy, we need to have discipline, and we need to have a risk management plan. But before all those, we need to choose a mentor. Well, as I was preparing this video, I went to YouTube and looked for, as I was searching through the videos, I noticed 2 people who are really doing this right. So I can suggest them for us. There's this channel called the Trading Channel, and there's this other channel called KLOG. You can go to YouTube, search the channel. They do prepare very wonderful videos. I would recommend them for us. Now, on to the main thing. We want to look at strategy, discipline, and risk management plan. So first of all, what is discipline? Okay, discipline is like adhering to a set of rules and goals. Yeah, that's technically what discipline is. And a strategy is a game plan. In this case, it's a technique that helps us determine whether we buy or sell a currency pair. Going on to the risk management plan. This enables us to implement a set of rules to ensure negative impact of a trade is manageable. Technically, what this means is that when your trade doesn't go the way you were expecting, you lose a little which you can manage. A good risk management plan should have like a 2% of the total capital in your account. For example, you put $100, but then in every trade you use $2 only, so that in every bit if you lose $2. That's a good risk management plan. Or maybe $1,000 and then you risk only $20. You don't want a situation whereby you have $100 and then you risk $50 or maybe $70. That way you'll have panic and you'll end up blowing your account. So technically what we can say is that a risk management plan helps us instill discipline in us. Well, risk management plan and discipline goes a long way towards strengthening our strategy in winning. Let's look at some terms that we'll be encountering. Now we have a risk-reward ratio. This we can break into 3 parts. There's a risk, there's a reward, and there's a ratio. A risk is like technically what you are ready to lose. A reward is what you are looking to profit, the profit you are looking for. And ratio is technically the fraction. So we can say that this is a fraction of potential profit versus potential loss in a given trade. That's a risk-reward ratio. A good risk-reward ratio should be about 2.52 and above. While traders make up to 1 to 7 or higher risk-reward ratios, it's technically good to make about 1 to 3, so that if you make a 1 to 3 risk-reward ratio, take 5 trades, you lose 3 trades and you win 2 of them, you'll have made 6 times the money you invested but lost only thrice the money you invested. So you'll be at a profit of 3 times the money you started with. That will be a profit. Let's go on to what we call a trend. A trend is the tendency of a price to move in a certain direction. It can either move up, that one we call an uptrend, or it can move down, that's a downtrend. So uptrend, downtrend. And then a trend line is a line drawn over the pivot high or below the pivot low. So this is whereby you look at the highest point of a trade and then you draw a line. That's a trend line. That will be our higher trend line. And then if you draw it below the pivot low, it will be another lower trend line. So these trend lines, they bring up what we call a support and a resistance. Support takes support like a floor. Now that's drawn beneath the pivot low. And then resistance is the higher part. Take it as the ceiling, like a house. So the support is down here the floor, and then the resistance is up there where you can't go past. That's what we know about it. An impulsive move is whereby a market moves strongly in one direction, either upwards or downwards. And these impulsive moves lead to what we call a swing, a sudden change or movement of the market in one direction. Either it can be an upward swing or a downward swing, leading to either an uptrend or a downtrend. And a consolidation is whereby there is a consolidation is technically market correction. Well, when price moves up and then it keeps on moving up, there it will reach a point whereby it goes sideways in a pattern to determine whether it will go downwards or upwards. That one we call a consolidation. It is technically a market correction, and mostly it's not favorable to trade during a consolidation because you don't know where the market will be going to, so you can really make a big loss or maybe a profit. You never know, but it's not a good practice trading during consolidation. Another important thing we need to know is what we call a candlestick. A candlestick is a way of representing a certain event in a trade. A candlestick is made up of a body which is rectangular in shape, and then two lines at the top and the bottom attached to the body. We call those wicks. Wicks, not whisks. A time frame is an amount of time in which a trade lasts. For example, when you download your trading software and then maybe look at the charts, you'll find that you can look at the markets in 1 minute time frames, 5 minutes time, 5 minute time frames, 30 minutes, 15 minutes, an hour, 4 hours, or maybe a day time frame, weekly also. But now that's what we call time frame. Now that we've finished defining all this, I want us to go to our browser or maybe your app store and look for these two apps or softwares that we'll be using for trading. The first one, look for MetaTrader 4, and the second one, look for TradingView. Go download them and keep them ready for the next session. Thank you. Go and download them and keep them ready for the next session.